We will ideation to IPO. I will be back. So during this next panel, we will explore the path from ideation to IPO. At least 3 African unicorns have already publicly expressed their intent of a US IPO, and several African fintech startups have surpassed valuations of $500 million, which is the threshold clearing the road to IPO. So in this conversation, you'll learn more about the routes, that can help generate, more stable and long-term capital, but also the difficulties to get there. To help facilitate this panel, Yinka Adegoke, who is currently the editor of strategic initiatives at Rest of World and the former African mastermind at Quartz. So Yinka will be leading the conversation. I think his mic is off. Yeah, there we go. Hi, Yinka. Yes, take a seat. And we'll have Miguel Azevedo, head of Middle East and Africa for Citi Group. Hossam Abou Moussa, partner at Apis Partners. Joshua Kaplan, corporate partner at Wilson, Sonsini, Goodrich, and Rosati. And Laura Kennedy, head of investments and corporate development at Shipper Cash.
Yes. Laura isn't here.
Laura is not here, so no Laura. Thank you.
After lunch.
Is this always there?
No.
No, it's not one man show.
Thanks for your patience. Just need one more minute.
Yeah, take some time to put the mics on. It's fine. We can start a whole conversation.
Thank you.
Maybe 10 people.
Yeah, come closer.
Wow, it's an all-man panel.
Yeah, I know.
You had to do that, Yinka.
I know, I feel
You had to be special like this.
Unfortunately, the one lady on the panel fell ill, so we are here.
It's fine.
How are we doing for time? How much time do we have?
You have 45 minutes.
40?
45.
Okay.
Over to you, Yinka.
All right. Thank you. So, thank you for being here. The post-lunch panel is always the most difficult to fill the room with, so we really appreciate every single one of you who's here. This topic is one which is fascinating for me because I've been covering tech for a while now, or more specifically, I've been covering tech for a long time, but covering African tech more specifically for the last decade. And a lot of this topic 10 years ago just felt like something just like fantasy, not even a realistic conversation. And it's kind of incredible to have a panel with such serious players discussing this in all seriousness because it has become very real. We have a banker, we have a lawyer, we have an investor. Unfortunately, the one startup we did have was not able to be here, and was also our one female participant, so we now have a panel. My name is Yinka Adegoke. I am the editor for strategic initiatives with Rest of World. One of the things that you learn as a journalist, the biggest dispute that journalists have to deal with is less about facts being wrong or getting things or being biased and all that stuff that you hear about. Sometimes it's a really simple thing where people have different understanding of what a word means or what a term means. And you write a whole story or a column or what have you, and someone calls you up, or usually these days they send you an email, and they say lots of terrible things about you, and then you know, if it's a reasonable person, if they're doing it in good faith, you ask, well, what's the problem? And you go back and forth, and you realize you have a slightly different understanding of a term or expression that everybody uses, and we all think we're saying the same thing. And I'm saying all this to say, I'm going to ask the most basic question to get started, which is, what is an IPO? Who wants to take that? Do you want to take that?
Of course, of course. I should be able to answer that.
Yeah, you should be able to answer that. And it sounds facetious, but it's interesting how people think about these things differently.
I'm with you. So very quickly, it's basically the moment where the company that you created stops being the company you created, and it becomes a company of investors. And it's a moment where you need to bear in mind that reporting, disclosure, transparency, all that is not a good thing, is a required thing. So it's the moment where you actually go public by definition, but public means you put your life in the public domain, in a sense. But it's also the moment where you get access to capital in a less limited manner. I was about to say unlimited manner, but nothing is unlimited. And it's also the moment where you get a currency, your shares, with which you can create further value by doing corporate combinations, by acquiring others, merging with others. So it is also the beginning of an absolutely new life for the company, for the entrepreneur, for the management team.
Excellent. Does anyone dispute any of that?
Won't dispute with the experts.
Okay, so next basic question, what is a SPAC? Because I see this in a lot of the notes that we were all given. Ask the lawyer.
Yeah, I guess I'll take that. I guess one way I'd answer that is to say, and just to build on what Miguel was saying, is that last year, there were really three paths to the market. One was the traditional IPO that Miguel described. The other was the SPAC. And the third was the direct listing.
Right.
And there haven't been many of those, but there have been some very well-known companies that have chosen that path. Palantir, Roblox, Spotify, of course, is the original example. In a SPAC, much like an IPO, there is there's a process, as Miguel said, of taking in public investors, and I'd say that that's the SPAC resembles the IPO much more than the direct listing. The SPAC it's a shell company that has been listed and that engages in a merger transaction with the private company. That merger transaction is called a de-SPAC. And at the point of the de-SPAC completing, you now have a public company. There were certain reasons why the SPAC was an interesting vehicle, in particular for growth companies, tech companies. But at the end of March this year, the SEC proposed rules that are going to basically align the disclosure and the liability regimes between IPOs and SPACs. And as a result, I think we will see much less of the SPACs. And this is interesting because last year alone, there were 600 SPACs that were IPO'd, and there were 300 de-SPACs. And roughly half of those de-SPACs were in tech and life sciences. So an important path towards the public markets is likely going to change dramatically in the coming months. And I think, you know, we've as a firm, we've already seen a significant slowdown in SPAC transactions. I'm sure Miguel would say the same about what his firm is seeing in the market in 2022. So I'll stop there, but we can revisit this as we talk today.
No, thank you very much. I mean, like I said, those questions feel pretty basic given the kind of the quality of the audience, but sometimes it's good to, you know, be on the same page with how we're thinking about this. And I will come back to SPACs because obviously there are, you know, various specific conversations to that. But we're here at the African Fintech Summit, so let's talk about African Fintechs, and let's talk about taking companies public. So let's start with you, Hossam, and please, you know, please tell us a little bit about yourself as we move forward. But my question first, which is just to talk about what you think the likelihood of us seeing more African fintechs or just African startups in general IPO particularly in the US, but maybe in other European markets as well.
Sure, thank you. So yeah, as intro, my name is Hossam. I'm a partner at a private equity firm called APIS. And basically what we do is we provide growth capital to financial services, technology-enabled financial services or financial infrastructure businesses across many markets. We're quite strong in Africa, South and Southeast Asia. And basically, I think to answer your question we've seen African businesses becoming unicorns. We've seen African businesses listing and kind of doing IPOs. I'll come to the question of which market is the most appropriate market, because it can be perceived that listing in X market is a success, Y market is a success. I don't think this is the definition of success. There is a reason why businesses would want to be listed in the home market or a different market, but there are requirements as well. So maybe I'll shift the question and to follow on my colleagues' comments on the SPACs and the IPOs, is actually when is a business ready to actually become listable on whatever approach, through a SPAC or an IPO. And there are some basic criteria that the business needs to get to kind of like getting to a certain level in each of these verticals to be IPOable or listable. So the first, of course, is scale. The business needs to be scale enough to be listed on a market. And depending on the market, the scale is linked. So you cannot have a business that is certain size and have ambition of becoming listed on NASDAQ. You can have a first step of listing in your home market, or you can just choose to list into a bigger market or a multi-region market. But definitely there is a scale element, and you need to get to the scale to be able to be listed. And definitely in the businesses we're invested in, or even conversations we have with potential partners, we advise against just having an aspiration to list for early. You don't want to be listed early. You want to get research coverage, you want to get enough liquidity, or it will just become a zombie listing, and that's not something that...
Sorry, what do you mean by early? Just what?
This is under the scale vertical. So basically, you need to get to a certain scale, you need to offer enough liquidity, you need to make sure that there are buyers and sellers of the stock, and there is research coverage in the market you're in to be a successful listing or a successful IPO. So that's the first thing. Second thing is there has to be clarity on the articulation of a strategy. Investors need to understand, because the investors you'll be engaging with, the level of depth is slightly different than a private equity investor or investor that is sitting in a room in a kind of a diligence environment. This will be basically investors you don't know, you have not met, and they need to understand the story in a simpler way. So there has to be clarity, and it has to be a strategy that is clear. You need to know your strategy, where you're heading, and now it's becoming public. You know, like basically people will actually know what are you up to, and you have to talk about your plans and performance and margins and numbers and all of that. So that's very important. There are hygiene factors. So basically, hygiene factors are the basic factors. If it's not there, don't even consider, which is basically having the right books, having ESG element, so basically there are hygiene factors that kind of like need to be there. And of course, above all, you need market conditions, because obviously there are cycles and depending on these kind of like where you are on these buckets, it's appropriate or not to be listed, and depending on many other factors, which like the market that's appropriate for your listing can be decided.
So much in what you've laid out there to break out. And you talk about market conditions, you talk about all these other factors, but I'm not sure, maybe I didn't hear you say this, but what about the factors of the investors who want their return, right? Are they a factor in terms of like they want to get their money back, and can you IPO or can you sell? I mean, what role do they play in this?
Well, IPO is not the only exit route.
Right.
So it's basically, there are many other exit routes, and Miguel is nodding, so maybe you can comment on that as well.
No, absolutely. And in fact, when I answered the IPO question, I oversimplified it a little bit, because these days, and in Africa in particular, and Hossam is a player in this space, you have what I would call, rather than the public market, the private capital market.
Right.
And it's also, the company also stops being your company when you do that. But in fact, in Africa, now being more specific into Africa, there's a big gap between the two. Africa right now, and fintech in particular, is far more a private capital market space than a public market space. We are all very excited with what's happening in the fintech. It's primarily private capital. The few attempts of taking some fintech companies and some sort of tech fintech companies into the public market have not been easy. So the public market for Africa is still not there. It's not necessarily what we would like to be saying here, but it's a fact. It's more private capital than public market. Now, the private market is becoming affected by the underperformance of the public market. So valuations are actually down significantly over the last 6 months because of that. That's not necessarily a bad thing, because it's becoming a bit more sustainable. We had a few excesses before. So that's very important, the private versus the public market. The other thing I would like to comment, connecting all these points that we have been covering here, is that SPACs were seen as a way of simplifying going public. Right now is the opposite. If you go through a de-SPAC, it becomes more complex. Yeah. I was working on 2 de-SPACs, and both have to be pulled. Abandoned, and we go into the traditional route. So it's, and that's particularly in Africa. And the final comment I would make is Africa is not a very well-known space for most investors. So when you're doing a SPAC or a de-SPAC, the investors that are comfortable with these SPACs, primarily US-based investors, some European, they don't know about Africa. And they don't want to be in Africa just because they don't know. The guys who know Africa and understand the risk and the opportunities and love it, they don't know SPACs. So if you do a SPAC and a de-SPAC in Africa, you end up with no one, basically, because you cannot fit those constituencies. So it's quite an interesting. Having said that, we are in a good position where we have seen record amounts of money in the private capital market flowing into Africa, and I have to believe that's the early phase of a successful public market in the next 12, 24 months. So I still think the future is bright here.
And just one other point as well on this theme of IPOs and SPACs. One thing we should also keep in mind is that for venture-backed companies, there's a sort of an 80-20 rule. 80% of most venture-backed companies their exit will be an M&A transaction. It will be a trade sale. Right. Only 20% will, at most, will end up coming to the public markets. So to Miguel's point, I mean, it's even in developed markets, it's a rare event to get to an IPO or to a SPAC or to a direct listing.
Right.
In Africa, it's going to be an even smaller percentage.
That's the number. I want to walk away from this panel with that number. If it's 80-20 in Silicon Valley or wherever, what is it going to be right now? Realistically, I mean, is it like the 1% or is it something?
Well, we would certainly, I think everyone on this panel would hope it's much more than 1%,
right.
But it's going to be somewhere between 1 and 20, right? It's not going to be more than 20%. And I mean, if we had to sort of pick a number out of the air, it's probably going to be closer to 10.
You get the same?
Well, depending what's the starting point, yeah? Like if you're starting from the point of real venture, then definitely the percentage of businesses that will go scale up into private equity space and then will go into being exited through kind of being merged into a business sold to a strategic or IPO, already there is a big filter. So depending where you take a snapshot of kind of like one and how many can be decided. Because obviously a lot of the early stage businesses might not even kind of like get into this scale point of actually being private equity investable appropriate. So if you start from businesses that are already venture backed, probably just around the 10 to 20% will be private equity, will be IPO'd. And by the way, I just want to go back to a simple point. It doesn't have to be the definition of success. It's one definition of success, but there are many other definitions of success.
Undoubtedly, I mean, well, just because you've done this most recently, I'm sure you have as well, Miguel. You all have, but I'm interested in your example, right? What are the most obvious lessons learned that you share with, I don't know, other startups or founders who are thinking about this?
Sure. So basically, I think these verticals that I refer to, they have to be very clear. Like if the ambition is to get into a listing and into an IPO, you have to plan this as part of your medium to long-term strategy, and you have to address these buckets. You have to actually address that. You need to scale up the business and become appropriate for a certain market. You need to address that actually the strategy is clear, consistent, evolving, because this will be the strategy that investors would back. And you need to kind of, before even getting to all the other hygiene factors, governance is very important if your aspiration is to be on a publicly listed environment, where everything from the shape of the management structure, the board, all the governance related issues, and then it's all about timing. So these are, I think, basic principle focus points.
No, but what are the lessons you've learned from the experience? Because you said these before, right? You talked about these are the things you should do, and now that you've done it, are those the same? Nothing's changed. You still feel that you want.
You mean life after the IPO?
Yes, exactly. Were there any things that surprised you, or that you learned, or you?
So basically, the businesses that I was involved in that did the listing, and the one you're referring to most recently is Fowry, basically were bracing well for impact. Right. So there was no surprise. There was already kind of a number of investors that have done this before. The management was very aware that they will be in the public eye. Yeah. The strategy was clearly articulated, so there were no surprises. I think the choice was the home market, because it's obviously it's a rational thing to do, to be listed in the home market if the home market is big enough. And this was an Egyptian business, and the Egyptian stock exchange is big and deep enough for the size of the business. So obviously it was appropriate. And I think after the IPO, there was a recognition that there is more demand for liquidity, and some of the institutional investors started basically offering this liquidity to kind of like enhance the flow.
Right. Miguel, when you think about when people come to you looking to go public or having those discussions, those early discussions, are they, is it just automatically assumed for, particularly if they're coming from certain markets like Nigeria and a few others that, someone had a big lunch. Is it automatically assumed that they will have to list on the NASDAQ or?
No, not at all. Not at all.
Because I was just following up from what Hossam said.
Not at all.
Serving the Egyptian market.
I think all markets should always be the starting point.
Oh, right, okay.
In some cases, it is very possible. In others, it's not. I'll give you an example. In Nigeria, we just did a $250 million offering for MTN Nigeria.
Okay.
It was 100% domestic. Having said that, in many, many cases, you end up saying, okay, now I really need to go to an international market to get a different pool of investors. And now we are seeing more and more dual listings, local and international. Again, Nigeria, we have seen that. We are seeing that, for example, in the Middle East, which is a few steps ahead, maybe. Mm-hmm. I think that will be more the norm. And sometimes the business becomes too big for the home market. And so you actually go into an international market, whether that's London or Amsterdam is becoming a real option. NASDAQ can also become an option, or NASDAQ or New York. But you cannot make the mistake of going into a market where you end up being kind of an orphan stock that no one really cares about you. And that's size-driven. That has happened in the past. I'm not going to say names, but that has happened. No. And so the risk of becoming a no one is a big one. So it's a balance between these different things. And sometimes you don't get it right. I mean, we ourselves, I think sometimes we went with one option that proved to be the wrong one. But it's life.
So
it's not definitive, though. You can change.
Right. I mean, it's a really interesting point. So, because that's why I was thinking about this question about dual listings, like how you.
Yeah.
Because if you heard what Hossam says there, I mean, you know this stuff. It's you're looking at the size of your market, you're looking at the size of the business, looking at the size of the opportunity. Then you go into this much larger market, and it's like, unless there's a really good story to tell here.
No,
it's
tougher. It's tougher. The scrutiny is going to be higher. The level of understanding that you get from investors and scrutiny is going to be tougher and higher. But in many cases, it is definitely worthwhile. Because again, you go public with a view of the future, of raising more capital into the future. It's not about going public and that's it. No, going public is the beginning of something. And if you go into a larger market with access to a larger pool of investors, that gives you more options into the future. So that's very real. But again, you have to be careful on not trying to run before you walk, right? So you have to be measured. Egypt, for example, as a domestic market, Nigeria as a domestic market. If you are in, say, Tanzania, there's not really a domestic market, to be honest. So you may have to go to somewhere else.
So how easy is it? So look at you here, George. If you have a client and they're very successful in Tanzania, and they've got, I mean, what's the population of Tanzania? 50 million plus people, and they've got, I don't know, 70% market share or something. I'm just making up numbers. So clearly they're successful. How easy is it for you if you're working with with Silicon Valley investors, what have you, to get them to tell the story, we want to take this we want to get this on NASDAQ or whatever. Is that an easy story to make happen, or is it just purely a financial, like, look at the numbers are great, that's it?
I mean, I don't disagree with any of the points that Miguel and Hossam made, but the reason why you see technology companies coming to the U.S. and not just technology companies, any company coming to the U.S. is it starts with these very basic principles we have, which are the rule of law, a market economy,
Right.
That has then been translated into the deepest and most liquid capital markets in the world. Just looking at last year's numbers, there were over 200 technology and life sciences companies that went public in the US alone. And that was actually evenly split between tech companies and life sciences companies. Within tech, it was sort of half application software. But the point is that there's a vast pool of capital available to growth technology companies in the US. So for companies in certain markets, and it's not just Tanzania, it could be the United Kingdom or France, right? The LSE hasn't been particularly friendly to technology companies this past year. You know, in Europe, it's also hard to find investors in the Europe public markets that are enthusiastic about growth companies. So there can be reasons why Nasdaq is the right place, even if the U.S. has nothing to do with your business. But once again, I don't disagree with Miguel. And Hossam also made this point very well, that you do need to tell a story, and telling that story about this Tanzanian technology company in the U.S. is not an easy thing to do.
So if it's an $800 million value Tanzanian business that is going to offer $150 million of like float in the market, this will not be successful in Nasdaq. This is too small. But if you have a $10 billion Tanzanian company that is going to offer $2.5 billion of float, this will get research coverage. It's big enough to get interest and get the liquidity. People will get interested in trying to understand the story. That has to be clear, well articulated. And of course, the governance needs to be there. So I think these are the drivers, not necessarily where is the business coming from.
And one other point, sorry, right before Miguel makes his point, is this whole point around where do you list, it's an important question to resolve, because at least our view is that dual listings are not actually something you want to pursue, especially as a young technology company, because you're dealing with two sets of governance requirements, two sets of reporting requirements. Yeah. It's incredibly complicated to do it, and it's usually the most mature and sophisticated companies that you see doing dual listings. Companies like Deutsche Bank, Shell, right? It's, you know, as a 7-year-old company, sort of spending your time solving governance requirements in two markets, reporting requirements in 2 markets. That's not a good expenditure of time and resources. Yeah.
Yeah.
The other and I fully agree. The other very practical point is when it comes to African companies, if it is a one country focused company, it's very difficult to take them public, because investors will become very afraid of the volatility in that particular market, whichever that is, right? So in our experience, if we are talking of Pan-African, and Pan-African means, you know, 3 or 4 markets at least, that's what people like. And people also see that not only as a risk management hedge, but also as a proof of concept that, you know, you succeed in different markets. So that's very critical in our view. Before going public, you should be performing well in more than one market.
That's really interesting. But in that sense, then there's not a huge amount of difference between the public and the private markets, right? Because it's similar sorts of
I think the private markets will be easier on that in that respect,
Slightly
because the private market investors, they do a lot more analysis of the market. And they come very much earlier in the process. So they can see, okay, I'm betting this guy is starting in Nigeria, but tomorrow he's going to go into East Africa. So they give room for that. But the public market already want to see that happening or having happen.
Yeah.
And it tends to also include lots of specialists in the private market.
In the private,
so for example, if we are looking at the business, we only invest in financial services and fintech. We understand the space. We live in these markets. We understand the markets. So we're very happy to invest, like write the big check, big valuation in a single market exposure. It can be done. That's not the case.
And you yourselves will actually help in this journey.
Correct. Also, part of kind of our articulation of value add is basically we've done it before in terms of taking a business and basically growing it through M&A or taking a business and sell it to a strategic investor, like for example, DPO, our kind of like online payment gateway, Pan-African, started in one country, expanded, became Pan-African, and it was scale enough to consider an IPO, but our exit route and the evolution of the business was a process, and it was sold to Network International. So it was folded into a business that it's listed.
Correct.
According to the, and I'm saying, excuse me, I'm being a typical journalist by saying according to, because I don't know the source for the numbers, so I have to say according to AFTS and the numbers they shared with me. It takes 4.9 years to 9 years to take a company public, and the kind of thinking behind the question is like, how do we get that process to be faster for African startups to go public, from literally, for as the title of the panel says, ideation to IPO. What needs to change? I know Hossam has touched on so many of the points about governance and all the rest of it. I'm wondering, Joshua, what do you see, particularly, and I'm trying to make this question as Africa-focused as possible, even though I know many of the rules just apply whichever region you're in.
I mean, I think, so first of all, the average is really 7 to 8, even in Silicon Valley. So Africa's not that far behind.
Right.
I think when we think about timelines, I think a more important timeline to bear in mind, rather than is it 7 years or is it 9 years, is how much time do you need to get ready to do the things that we've been talking about today, so that you have a successful public debut, and at least for the U.S., just the process of getting your registration statement done, getting yourself ready to actually start trading on the markets, that's a 6-month process. But typically, when you start, in terms of thinking about when you want to start making changes to your board structure, to your senior management teams, so the governance changes, when you want to start thinking about your financials and preparing those to meet the auditing standards of a public company, for that process, you want to start really 18 months in advance. So in total, you're really thinking of potentially as much as 2 years, right? So if your target date to be public is whatever, you want to work back 2 years from that. And I think that's the important timeline for people to keep in mind.
Yeah. Because
these numbers, 7, 9, they don't really mean much. It's very idiosyncratic. It's really dependent on the business, and as Hossam mentioned a couple times, it's really, really dependent on market conditions, right? And none of us control that. So I think that the important timeline to focus on, at least for the U.S. capital markets, is that 2-year period. So that sort of 18 months of getting ready, and then 6 months of actually spending a lot of time with our firm, with Miguel's firm. That 6-month process is painful, but at the end it
pays off.
Yeah,
if
exactly.
well done.
Just one quick comment. Just a summary. When it comes to the timeline of this journey, right is far more important than tight. Right? You want to get it right, not tight.
Wise words. Just because we got 5 minutes, I just want to check if anyone had any questions for the panel while you're thinking about that. Just a sort of last question from me, because we're going to wrap up. Who are you expecting to be knocking on your door over the next, talking about going public in the near future? Who are you watching from afar, even if they're not as a client, not.
Listen, I can start, and it's just a comment based on public information. If you look at the fintechs in Africa, the one that has achieved so far a higher valuation in the private capital market is Flutterwave, has been here today. So I would say that I would expect them to be the first one to go public in a big way, just because they have already achieved the scale, everything that we have spoken here. So that would be my bet.
Any others?
Well, I would rather not to be kind of like specifically narrowing into specific names. I think there are a number of players. Of course, scale is very important, and all the other points are very important. I think the only comment is, like, it was such kind of a great feeling and an honor to kind of like ring the bell and be involved in an IPO. So it's a huge success. But definitely, if you take like the definition of success, depending how you want to define it, if it's from financial return and having successful delivery of an investment story, definitely sale to a strategic investor were more successful in the cases I was involved in. So we don't have, like, of course, it has a lot of feel-good factor to get to this point of ringing the bell,
right.
But it's not necessarily the only way to drive your strategy and drive your business and drive the aspiration.
Joshua?
Like Hossam, I don't have a name that I'm going to give you, but at the moment, I would say, as a firm, we're actually focused on much earlier stage companies right now in Africa. We look at all of our clients as having the potential to get to an IPO, and our model as a firm is to work with our clients from that sort of Series A round through to the exit, whether it's an IPO or an M&A, and so we're at that stage right now where we're working with a number of clients across Africa who we believe have that potential, but it's not next year.
I mean, that's an interesting point, though. You're thinking about this at a much earlier stage. You're trying to make sure that if this happens, everything is in order.
We're as a firm, we're biased towards company side representation, and we think about our clients as life cycle clients. So we want to be with them through their entire journey, and then we continue to advise them as public companies. And so that's how we're looking at the market right now.
By the way, this is very important, because if you build the correct foundation from the venture stage, where you're properly advised, you have proper governance, you have proper legal structure, proper documentation, I think you'll get to the point that Miguel was referring to, is doing it right. So it makes life easier. So it's a very good strategy.
You see, just as a final comment from me on this, in the early stages, firms like mine, investment banks, are not even welcome, right? When companies are talking to people like Hossam, thank you. It's a different game. But we try to follow them, we try to be close to them, you had here this morning AppZone, TeamApp. These are all companies that are on a very pre-IPO stage. We try to be close to them, we try to be helpful, because we believe they will get there when they will need an investment bank. We have been following them for quite some time. So it's quite a journey, let's put it that way.
Okay, well, thank you for taking us on this journey, talking us through the Ideation to IPO panel. Please join me in thanking our panelists.
But the key word is ideation, not IPO. It all starts with the idea.
Exactly. Thank you.
Thank you very much.
Thank you very much.
So much. Thank you. We're going to have a 20-minute break, coffee outside for you to stretch, and then we can meet again at 4:20 in this plenary room. We will be listening to the intersection of trade and fintech, and breakout rooms, we'll have a fireside chat about the confluence of fintech, Web3, and the metaverse, followed by investing in Web3 and the metaverse ecosystem. We'll see you back at 4:20. Thank you.